Bring in a non-believer now. Michael Yoshikami is the founder and CEO of YCMNet Advisors, which manages more than $1 billion in assets. He says Zynga's valuation isn't justified. And Michael, welcome back to Bloomberg.
Thank you very much.
So you are very skeptical about Zynga. What is your biggest concern?
The concern I have is I think that what's happening right now is there's such a frenzy in anything that is remotely social networking. Zynga is set to come out with a typical offer, the type of offering that we've seen in the past, a very, very low float, which tends to make the stock rise. But the question is, are really the fundamentals, do they really justify the current price? You correctly pointed out in your intro, a tremendous amount of the revenue is really dependent on Facebook. There's nothing that says that Facebook one day couldn't decide they want to keep that revenue for themselves. So I think there are real questions in terms of what the valuations should look like. $20 billion just seems like a very rich valuation to me.
That said, this is a company that's expected to bring in $1.5 billion in revenues this year, $500 million in profits, and you've got companies like Groupon and Pandora that have no profits.
Well, that's comparing, I think, a speculative company with an even more speculative company. I mean, Pandora, certainly, it's hard to really say how they're going to make money at this point. So I don't think that's really the comparison. I think the comparison is more this company against more established companies like Google, for example, that are actually bringing in real revenue, companies like Oracle bringing in real revenue. This is an untested model, and it's just hard to say what the landscape is going to look like. When you have a valuation of this company that is higher than Electronic Arts, a company that's been around, that has tremendous franchises already established, it's just hard to really see how the valuation can really be justified. How
important is it for Zynga to diversify outside of Facebook, and is that even possible? Is that their main game?
Oh, it's critical that they diversify outside of Facebook. But the problem is, where else are you going to go and get that sort of distribution? That's obviously the huge advantage that Facebook has. They have a massive user base of 750 million users, and they can roll anything out that's going to be probably successfully adopted by the public just because of the amount of people that they have to add to the distribution chain. But if you look at what Zynga needs to do, they need to go outside of Facebook. Otherwise, you're going to have a situation where Zynga is really going to fall prey to whatever Facebook dictates, and Facebook has a reputation of dictating conditions.
All right, let's bring Cory back into this conversation. He's been, of course, looking at the timing of this filing. Cory?
Yeah, Michael, when you look at this as a money manager, what reasons would a company want to wait if they don't make the deadline for the end of the quarter?
What reasons would Zynga want to wait?
Yeah.
Yeah, I think if they're really confident about what their revenues are going to look like, they want to have more revenues under their belt. I guess you could speculate that perhaps they want to let more demand build up in terms of what's happening with social networking stocks. But my view is I think it's in Zynga's best interest. If I'm sitting on Zynga's board of directors, I'm saying there's a frenzy out there right now. There are people that are dying to invest in anything that has a social networking taint to it. I want to get those shares out as soon as I possibly can in case that bubble pops.
Michael, what kind of things would make the bubble pop? I mean, there is an IPO appetite right now. Clearly, a lot of companies have been coming out. We've seen more deals already this year than we've seen in quite some time.
Well, I think in the short term, there's not a lot to make it pop. I think that there's just such a dearth of names available. And again, the big name of Facebook is just not available right now. So people are really putting their money in where they can put it. And the problem that we really see right now, this is when I think it's very important that investors recognize their short versus long-term perspective. The float that is being offered in these companies really, in my view, artificially increases the prices of these stocks because there's so much demand for a limited amount of shares. What happens when more float goes out into the marketplace? That, in my view, is going to be a problem.
It seems to me also it'll be interesting to see how they define revenue recognition when we see this offering finally, because with virtual goods, it's a question as to how long a good is in existence and how long they have an obligation to the customer who paid for it to keep that thing around.
Yeah, absolutely. We're in a point. It's kind of incredible. We're at a point now where we're actually talking about virtual goods. It's really obviously the next generation in selling product and services. But you're absolutely right. Revenue recognition is going to be a major issue. And if, in fact, we have change in business relationships, maybe change in a business relationship with Facebook, how might that change the accounting practices? We just don't know at this point.
All right, Michael Yoshikami of YCMNet Advisors, thanks so much for your non-believing perspective on that.
Thank you.
Great to hear.